So when you look at the royalty and streaming model, that's ideally suited to get optimum leverage to a rising gold price. Gold price is going much higher than where we are today. And the royalty and streaming companies give you that top line exposure. You get a percentage of the revenue, but gives you complete inflation protection. But also you get optimum leverage to the expiration of our operating partners. That means that when the operators drill around their existing mines and deposits, conduct what we call brownfield exploration around their existing industrial complexes, you get the benefit of that upside without actually having to pay for it.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. I'm your host, Daryl Thomas, and today we have the pleasure of meeting with the CEO of Gold Royalty, David Garofalo. Did I say your last name right?
You did. Very well done.
That's good. That's good. How you doing today?
I'm well. How about yourself, Daryl?
Yeah, I'm doing good. Just at the Royal Symposium, so the audience sees a different background. I'm in Boca Raton pretending like I'm rich, y'all.
Well, there's a lot of wealth there, and a lot of successful people that have followed Rick's recommendations over the years.
Yes, agreed. And so I actually got to know Gold Royalty last year, and over the past few years, I've been learning more about the royalty and streaming model, and just because for a while, bullish on gold, and just, you want the exposure through the equities, and obviously mining can be risky and has a lot of things that can go wrong. And so the royalty and streaming model was just something that really stuck out to me. And so you have a lot of experience in mining and such, and what's kind of your path and how you got into the royalty and streaming?
Well, I actually started out as a CPA back in the 1980s and started in a very junior position with a copper company called Inmet Mining back in 1990. And then kind of worked my way up the ranks, eventually to treasurer there. 12 years at Agnico Eagle as CFO. Agnico, as many of you know, is the largest cap gold company in the world now, and was there during its formative years as we built out about a half a dozen mines. Went to run Hudbay Minerals back on the copper side for about a half a dozen years. We built 3 mines there, and then ran Gold Corp until its merger in 2019 with Newmont, and then founded Gold Royalty about 5 years ago. Took it public in March of 2021, and here we are today.
Yeah. So you've been on a journey. So thinking about just royalty and streaming, like what was something that really just stuck out to you? Like, this is the business model that I want to establish, that I want to focus on.
Well, it's fit for the point of cycle that we find ourselves in, both from a metal perspective, but also when you look at the producer universe, we're at a unique point in the cycle as well. From a commodity standpoint, gold is poised to be a significant outperformer as an asset class relative to virtually anything else in the world, and has been for about 50 years since the US dollar was decoupled from the gold standard. It's really been a one-way trade over 50 years. Gold's gone up 100-fold over 50 years, and the purchasing power of the US dollar has decreased by 99%. So there's a very direct correlation between the two over time. And given the amount of debt that's been strapped on globally, and particularly now with the big, beautiful bill in the US, there's going to be more debt strapped on. The US dollar is going to have to be printed with reckless abandon, as other Western currencies have to be. And as a result, you're going to see a continued devaluation of that currency against gold. The question you have to ask yourself, if you believe in gold as an asset class for the reasons I've outlined, is where are you best positioned to get optimum leverage to the gold price? And having been a producer and mine developer for 35 years in this business, I don't think that's the end of the spectrum you want to be in, because the industry is actually shrinking. There has been a lack of investment in exploration in the ground for well over a dozen years. And as a result, the industry is shrinking. It's gone down 40% in terms of reserves in the ground over that period of time, simply because the producers are depleting more than they're finding. And that's because the juniors haven't had access to capital, and they can't conduct the grassroots exploration that the industry desperately needs to replace those depleting assets. So why would you want to invest in a shrinking part of the sector where value is declining and all they can do is cannibalize each other? And we've seen a lot of M&A occur in the producer universe, which really adds no value. It creates a bigger vehicle, but not one that actually adds value in the ground. And you couple that with the fact that the industry is not immune from inflation we're seeing in the general economy. So their input costs have gone up. And so we haven't seen an expansion in margins among the producers you would expect with gold prices at all-time highs. In fact, over the last 30 years, margins in the industry have been pretty static at about 30%. And so that's with gold prices rocketing up. That's because cost structures have rocketed up. Reserves are declining. The only thing that the industry has been able to grow on the producer side is their share count. They've been issuing more and more stock to do M&A to replace depleting reserves and production because if you can't find it in the ground, which they can't do because the explorers aren't exploring, then you're going to have to buy it. But that's not a value-added proposition on a per-share basis. So when you look at the royalty and streaming model, that's ideally suited to get optimum leverage to a rising gold price. Gold price is going much higher than where we are today. And the royalty and streaming companies give you that top line exposure. You get a percentage of the revenue, but gives you complete inflation protection. But also you get optimum leverage to the expiration of our operating partners. That means that when the operators drill around their existing mines and deposits, conduct what we call brownfield exploration around their existing industrial complexes, you get the benefit of that upside without actually having to pay for it. In our case at Gold Royalty, our operating partners on average over the last 5 years have invested $200 million US per annum in exploration on the properties upon which we have royalties. We've gotten the full benefit of that exploration upside. We've contributed absolutely nothing to their exploration budgets. That's the attractiveness of the model.
Yeah, that's a lot of value there as well. So just speaking more, about the company, I was just looking at the recent fact sheet and everything, and so there's a lot of, I mean, you have over 240 royalty and streaming interests, and that's a lot of companies and mines and stuff that you all have access to and that you all are benefiting from. And so is that plan to grow that or to kind of just focus on the current portfolio that's there?
Well, we've gone from 18 royalties in our IPO to 247 royalties today. So it's been a fairly steady path of growth over the last 4.5 years since our IPO. And we've done it through multiple platforms. When we had the currency to do so, we were rolling up some of our peer companies over the course of 2021. We bought three companies through M&A, and that allowed us to expand and diversify our portfolio very quickly. When our currency really wasn't there in 2022, as interest rates went up and the sector derated, we just didn't have the currency to do M&A. We grew through project financing, where we provided capital to developers to build their mines. We grew through third-party royalty acquisitions, where we bought royalties from, prospectors and other companies that had royalties in their balance sheet that they simply, wanted to monetize. And we've done organic royalty generation. We generate about 2 to 3 royalties per quarter through our staking efforts. We don't conduct exploration, but we do like to stake properties around existing mines and deposits and then farm them out to the operators and take royalties back in return, and quite often get option payments on those properties, which helps defray our G&A costs. So you're always going to see us steadily grow, excuse me, but we're going to do that on a very disciplined basis. Where we can't use our currency today, we can't do M&A. We'll do value accretive acquisitions through our organic royalty generator. So we haven't done any major deals in the last 12 months or so, but we have generated over that period of time about 15 to 20 royalties through our sweat equity. So you always see a steady growth in our royalty portfolio for the foreseeable future, even when we don't have the currency to do so. That's the beauty of our model, having multiple platforms of growth, so that we're always growing in some respect, but always doing it on a cost-effective and a creative basis.
Yeah, that's really good. So with the I was looking at the CAGR, and right now annually it's at like 60%.
Yeah, so that's right. It's about 60% compounded annual growth in our revenue through the end of the decade, principally from some of the largest scale operating mines in the world. So we're looking at 360% cumulative growth through to 2028. We provided 5-year guidance for the first time, and our gold equivalent attributable production from our underlying royalties. And they're coming from some of the biggest operating mines in North America. We have royalties on 3 of the 5 biggest producing gold mines in North America, namely Canadian Malartic and Côté in Canada, and the underground extension of Goldstrike, which is called Ren in Nevada, which starts production under Barrick's operatorship next year. So we have generational assets that are generating the majority of the growth. Over 85% of that growth, that 360% growth, is already built and operating. And some of it is being expanded. So it's essentially de-risked from a construction standpoint. And now we're at a point where we're harvesting meaningful returns from the investments we've been making steadily in a disciplined fashion since our IPO in March of 2021.
hmm Yeah, that's good. That's good. And I was also looking at the price to book right now, the price of the share price compared to the net assets. It's sitting at around it's less than one. I mean, at here on the corporate presentation, it's at zero point 0.8, and the industry average is 1.5, and then the bigger names are they're almost 3 times that. And so, what are you seeing there as far as like the growth and re-rating of the valuation for Gold Royalty?
So there's been an absence of generalist equity investors in the space. Even though the gold price is well above record highs recently, we haven't seen generalists rotate out of the general equity markets, for example, technology stocks, into natural resource stocks in any meaningful way. So multiples, I'd say, largely are quite depressed for growth stories. So in other words, growth is being very severely discounted in our sector, in spite of the fact that gold prices are at the levels that we're enjoying right now. And we have the best growth story among all the royalty and streaming companies. And so we're probably the most severely discounted. So this is the kind of market that will pay for the growth when it's in the rearview mirror for a couple of quarters. And this is our inflection year, in that we're going from investing into our asset base, as we've done over the last 4.5 years, to actually generating positive free cash flow for the first time starting this year. And that grows exponentially over the next 5 years, because that 360% revenue growth is against a cost structure that's flat. We have about $7 to $8 million of cash G&A a year. If you apply current gold prices to our guidance towards the end of the decade, you're looking at $80 to $90 million of revenue against $8 million of G&A. It's a 90% margin business by the time all of these assets are hitting stride. And that's a very attractive place to be. That means positive and growing free cash flow. The market will attribute a much higher multiple to that when we've actually demonstrated and crystallized that growth over the coming quarters.
Got it. And so, and then since this should be the year where positive cash flows, what's the plan with that? Is it like to pay off debt, buy back shares? What's kind of the thoughts there?
Yeah, no, it's an excellent question. Our absolute focus in the short term is deleveraging. So we've drawn up about 1/3 of our $75 million line of credits, just a little over $27 million drawn. And we want to pay that back. That's like credit card debt. We used it to finance the acquisition of a couple of meaningful cash flowing royalties over the last couple of years. And so we want to deleverage, in other words, reload the credit card so we have it available so we can act opportunistically if further accretive opportunities present themselves to provide near or immediate cash flowing royalties into the portfolio. And then we'll look at returns of capital when we're in steady free cash flow territory, really starting next year. By the end of next year, we're effectively debt free. We're in a position to contemplate returns of capital to shareholders. If our valuation remains depressed at these levels, then we'll buy back our stock. That's probably the best use of our capital, reduce our share count and acquire our stock at a discount. And that's going to be meaningfully accretive on a per share basis. But we'd also like to introduce at some point a meaningful and growing dividend to our shareholders, because real businesses pay dividends. It demonstrates capital discipline. At the end of the day, a royalty company is a collection of annuities, from really capable operators and good minds. And so why not share that annuity with our shareholders in the longer term?
hmm Yeah, got it. And so with the so obviously, the growth rate is significant, cash flow positive. Those are all good things. It's like some investors, like they worry about like share dilution, especially even here at the Real Symposium, where
Yeah.
companies need capital, right? And so currently, I was looking at the fully diluted share count and such. And so, is there any concerns there? I mean, well, I mean, obviously, you'll probably speak to it different and maybe than concerns, but like, investors may be thinking about that. And so, what do you have for that aspect of this business?
Yeah, look, we've been very disciplined in terms of raising capital. We did our IPO back in March of 21. That was our first equity raise. We raised $90 million in our IPO. And then we did an equity raise in May of 2024 to finance the acquisition of the copper stream on the Varus mine in Bosnia. And that's been a meaningfully accretive deal, one that actually resulted in the takeover of Adriatic Metals by Dundee Precious Metals recently. So that just demonstrates the quality of that asset. It's a very long life mine. We've done no other equity raises in our entire nearly 5-year history. So we've done 2 deals to raise equity where we had a defined use of proceeds, both in terms of the IPO, that capital was deployed to roll up some of our competitors and acquire some other royalties over the course of the last several years. And then again, last year when we did the Varus deal. Otherwise, we just have not been to the equity markets. So we've been very, very careful to make sure that our share count stays low so that our per share cash flow growth is meaningful.
hmm Yeah, that's good to hear. And so, like, there's also like concerns that investors may have about like acquisitions or like if someone was to acquire like gold royalty. I saw recently I think Sandstorm got acquired or whatnot, and so that's kind of what. Could you speak to that?
Yeah, look, consolidation has been happening. And it's been happening really since March of 2021 when we did our IPO. We started consolidating the sector. We saw it as a fragmented universe with too much G&A and not enough diversification within individual portfolios. So we bought 3 companies over the course of 2021, Ely, Golden Valley, and Abitibi royalties. And we did that on a very value accretive basis on a per share basis. And we've seen about a dozen other peer companies disappear over the course of the last several years. More meaningfully, recently, Sandstorm being bought by Royal Gold, which is one of the seniors in our sector. So now even the seniors are starting to participate in the M&A sweepstakes. And that will happen because there's probably, by our estimation, somewhere north of $75 million of excess G&A in our industry. There's just too many companies chasing too few deals. And that G&A can just simply be vaporized because when you think about it, when you put 2 royalty companies together, you're just rolling a filing cabinet from one office to another. You're able to realize 100% synergies on the companies you absorb. And that certainly was the case with the 3 companies we took over. We eliminated 100% of their G&A expenditures when we absorbed their royalty portfolio into ours. That equated to over $10 million per annum of G&A savings for shareholders. And as I said, there's about $75 million of excess G&A that can simply disappear. Sandstorm is going to disappear as a company. Royal Gold is just going to absorb their portfolio and then they're going to eliminate all of their G&A costs. There's more to that to come. But also, as we attract generalists into the sector, we want to create bigger and bigger royalty companies that have both the liquidity to attract generalist investors, but also have growth. And when you look at the largest royalty companies in our space, namely Franco, Wheaton, and Royal, all of whom are fantastic companies with great management teams, they're too big to grow. They're great assets, great portfolios, great cash flow, but they don't have growth. And what we need to provide generalist investors is an alternative to the seniors that's big enough to be meaningful and liquid enough for them to own, but still small enough to grow, almost a Goldilocks type company. And I would argue that doesn't exist just yet.
hmm
There's the big guys at 15, 30, $40 billion market cap, the 3 that I mentioned. And then it's a steep drop off to sub $5 billion market cap. There's nobody in that mid zone of $5 to $15 billion market cap that is in the Goldilocks zone. That's a void that the industry needs to fill through consolidation. And that's always been our driving corporate vision is to participate in the creation of that mid-tier vehicle that provides that, as I said, liquidity and investability, but also meaningful growth. And I think that has the potential to attract a multiple superior to the 2 to 3 times that the big guys are getting because generals simply don't have an alternative to invest in right now that's investable.
hmm Yeah, yeah. I was thinking about when I got into gold royalty. I think it was at $1.20 or less, a little less than that, and then now it's trading at $2 and some change, $2.30, whatnot. So if this this valuation, increases, triples, quadruples or whatnot, I mean, we're looking at what, $8 stock, $9 stock.
Well, let's say that we're at a 90% margin business by the end of the decade and we're generating, $90 million of revenue against $8 million of G&A. So that's $80 million of free cash flow per year. What kind of multiple do you attribute to that? We're a $400 million market cap company currently, just under that. I don't know, do you put a 20 times multiple on that? That means our stock quadruples from where it is today. So not that different than what you're projecting, Daryl.
Yeah, yeah. So there's still a lot of potential for growth. I mean, I actually increased my share count. This is not financial advice, you all, but I think this is a solid company, and I appreciate you taking the time to dive deeper into that.
Oh, it's my pleasure.
Yeah, so where can people find more information? I mean, obviously goldroyalty.com. I mean, you all are doing corporate presentations and such. I mean, if folks are here at the Real Symposium, they can always go to the booth and get more information from Peter. Anything else the audience should know?
Yeah, I mean, the other people can reach out to. Peter's there, as you said, physically in the person. Peter's been he's employee 1A when we we founded the company privately back in 2020, so knows the business inside out. He's our director of corporate development and investor relations. Jackie Przybylowski, who used to be the lead mining analyst at BMO. She covered all the senior large cap companies when she was a sell side analyst. Jackie's our VP of Capital Markets in September. So you can reach her, Jackie P at goldroyalty.com. And then you can reach me as well, D Garofalo at goldroyalty.com. We're eminently reachable, always happy to hear from investors and happy to return your messages, calls, however you want to reach out to us to learn more about our story.
Yes, yes, indeed. So you all got the information. I'll link to that in the description below. Appreciate you for coming on the show, David.
My pleasure.